Hey, how's it going, insiders? We're having a historical moment in the financial market right now. No, it's not AMC or GameStop. For the first time in the entire modern finance history, the US Federal Reserve officially owns more treasuries than all the foreign nations combined. The warning signs which those legendary investors like Ray Dalio and Stan Druckenmiller have been telling us for years have just arrived.
You think we've crossed the Rubicon? Are you comfortable saying what you said there, that for the first time in your career, you think we lose reserve status?
I'm comfortable with it. That's my central case.
Yes, we are officially at the beginning of the end of having the US dollar as the world reserve currency. Such a huge, significant event that will impact every single corner in our financial market. And with no doubt, the number one easiest and also the safest market that will explode in the coming new macro environment is gold. That is why in this video, I will deep dive into both technical and fundamental analysis on gold, share with you guys why there's so many smart money investors believing the next massive bull run for gold is about to start. And of course, I will share with you guys some strategies to make the most profits out of this coming precious metal super cycle that you can't afford to miss. Alright, let's get started. Whenever I analyze a market, especially a market that is about to break out into a long-term trend, I always like to zoom out and start from the big picture. This is the gold monthly chart over the past 25 years, from 1995 until now. As we can see, at the beginning of this chart, gold was in a tight range consolidation for about a year and entered a bear market. The maximum drawdown of this bear market was 39.5%. Gold reached the bottom in April 2001 and started coming back up. It took gold 108 months to form this massive cup and handle pattern, which is definitely one of the best dream patterns to signal a coming massive bull market. In January 2005, gold finally broke out of this cup and handle pattern and started a major bull run. This bull run lasted for about 78 months. From the cup and handle pattern breakout point to the all-time high, it was about 360% return. Remember, for an asset that has the volatility almost as low as any major currencies, a 360% increase over a period of 78 months is an extraordinarily high return. Because such low volatility like what gold has allows investors to take a much higher leverage without taking too much portfolio risk. So after the gold hit the all-time high around 2011, it started another one-year tight range consolidation like what we had back in 1995. Then enter another bear market at the end of 2011. The maximum drawdown of this gold bear market was 41.3%. It reached the bottom in 2016 and started coming back up again. And right now, once again, gold is perfectly forming another classic textbook cup and handle pattern and ready to break out. As we can see, no matter it's the time duration or the maximum drawdown, this cup and handle pattern we're currently having right now is exactly the same as what we had from 1996 to 2005, right before the greatest gold bull run in the history. Let's zoom in closer and take a look at the weekly chart. So as we mentioned earlier, the previous bull market reached the top in August 2011. The price was around $1,900 and it entered a 5-year bear market and crashed more than 40%. By the early of 2016, gold started coming back up. Especially in the most in 2 years, gold went up almost 80%. In August 2020, gold actually broke the previous top, made a new all-time high, tried to break this top resistance and go higher, but failed. That is why we're seeing gold had been in a short-term downtrend since August last year, but quickly find a large amount of buyers at around $1,700 price level and then bounce back up. This is a very typical trend continuation move in a healthy bull market called the bull flag. So now the key question is, when exactly we can expect the gold will be able to break out of this cup and handle pattern and what price level should we look at? To answer this question, we need to look at the daily chart. As we can see on the daily chart, at the end of the downtrend channel, gold has completed this classic 2-month double bottoms, perfectly touched the support level of this trend channel and went back up. It broke this downtrend in May and formed this very strong short-term uptrend trying to break this cup and handle resistance level. On this chart, we can see that the strongest resistance level for gold right now is from $1,900 to $1,960. So as long as gold stays in this strong short-term uptrend, we can expect gold will be able to break out of this resistance level by July. If gold successfully breaks $1,960 and makes a new all-time high that is higher than the August 2020 top, then there will be an extremely high probability that gold has officially broken out of this 10-year massive cup and handle pattern consolidation and enter a new major bull run. If the historical supercycle repeats again, that will send gold to almost $7,000 by 2027. Alright, these are all the pure technical analysis on gold. What about the fundamentals and the macros? Let's see if the fundamentals and the macros support our technical price target. If you think the technical analysis makes gold look extremely bullish, then I can tell you this. On the fundamental side, the current macro environment is even more bullish for gold. It's safe to say we've never had such a crazy, irrational macro environment created by the Federal Reserve that is so perfectly set up for the asset classes like gold. In fact, this is exactly what Stan Druckenmiller said.
And yes, I can't find any period in history where monetary and fiscal policy were this out of step with the economic circumstances. Not one.
So where exactly are we right now in the macros? As I mentioned earlier at the beginning of this video, for the first time in the history, US is holding more treasuries than all the foreign governments combined. This is huge, guys. Not only for us retail investors, even for those billionaire hedge fund managers like Stan Druckenmiller, who has been in the market for almost 50 years, has never seen such thing before. In fact, this is what he said on this issue.
Last spring, in the midst of an equity market meltdown, and I've been trading for 40 years and I've never seen anything like this, right in the middle of an equity market meltdown, the bond market went down 18 points one day. And everybody thought it was macro traders like me and others that were rejecting the implications of the CARES Act. The Fed did a deep dive, and by hindsight, foreigners sold $1 trillion, of treasuries overnight as we were proposing the CARES Act. They've continued to sell treasuries ever since then. Why is that important? Because for 20 years, treasuries have been the go-to asset of foreigners to hedge global portfolios with. In every case, whenever you had a problem in the equity market or in the world economy, they fled to treasuries and they fled to the dollar. Last spring, that was violated. So since then, they've continued to sell treasuries. So what we've gone from is for 20 years, an average flow of $500 billion a year into treasuries from an outflow out of treasuries. So when you have a $700 billion current account deficit, our estimate for the year, you need capital to flow in to offset that. If you just erase $500 billion inflow and turn it into an outflow, you see the pressure will put on the dollar. If 10 years go to 4.9%, which is their normalized projection, the interest expense alone will be close to 30% of GDP every year. That's basically what we just spent on the COVID emergency in the last year. There is no way we can afford to have 30% of all government outlays be toward interest expense. So what will happen is the Fed will have to monetize that. When they monetize it, I believe it'll have horrible implications for the dollar. And that's why I said in that speech, yes, that I think it's more likely than not, within 15 years, we lose reserve currency status.
All right, there are a lot of great insights to unpack from this interview, but there are basically two main points that Stan Druckenmiller is worried about. First, there is an emerging crisis going on in the US Treasury market that is shaking the dollar reserve currency status. The US Treasury is considered the #1 asset class in the world because it's backed by the US government. Even if the US run out of money, the government can always print money to pay you back. It's pretty much the only asset in the world that has no risk. And because of this, US Treasury is the single most important asset that is owned by the foreign investors, especially the foreign governments who have much less stable currencies compared to the dollar. That is why this dollar standard is so important to the US government. It provides the US government a massive privilege to print as much money as they want because they know there's always a demand for the dollars and the dollar-backed assets from the foreign countries. And the foreign demands for the dollar are always much higher than the US itself. But right now, the table has officially turned. Since 2008 global financial crisis, and especially last year, the 2020 COVID crisis, the Federal Reserve completely went out of control, printing trillions of dollars like there's no tomorrow. And because of such massive QE programs that the US government decided to implement, the foreign government have been gradually losing their trust on the US treasuries, and as well as the dollar as the global reserve currency. That is why we're seeing foreign investors have been selling their US Treasury holdings massively since 2008. And pretty much the only buyer for the US Treasuries over the past 13 years was actually the Federal Reserve. And here are the things you have to know as an investor right now. First, if the foreign government are giving up their dollar assets, then what are they buying instead to back their own currencies? Well, you guess it, it's the gold. According to the Bank of England, the buying pressure on gold from the foreign central banks around the world have been increasing massively. And even worse, on top of that, because the demand was so high, they don't even mind paying unusually high premiums in order to just get more gold reserves. This type of behavior only happens during a major currency crisis. So that tells us there are definitely some major potential risks that the foreign governments are seeing right now that have not been fully priced in the gold market yet. And the second thing is, why does the Federal Reserve have to keep buying those treasuries? Especially the economy is already recovering faster than expected and the current inflation is already red hot. Well, simply put, if the Fed stops buying those treasuries, the yield will go up and go up a lot higher because there's less and less demand from the foreigners. That will make the cost of national debt way much higher. As right now, US Federal Reserve is the largest treasury holders in the world right now. And the US government has more than $28 trillion on national debt. They just simply cannot afford a higher interest rate on those debts. So in other words, basically the Fed has to pick the poison. Either they stop printing money and stop buying those treasuries, which will instantly crash the market, or they keep printing money and being the biggest buyer of those treasuries and keep the rates artificially low, but that will slowly destroy the US dollar. As we all know, the Fed has already made their decision. They're going all in on the option B. And that's exactly another point which Stan Druckenmiller extremely worried about. Since the Fed has already made it clear to the public that they will support the market with the massive QE programs, with the current rate of the treasury purchasing by the Federal Reserve, US dollar will no longer be the world reserve currency within 15 years. And if we combine these two macro developments that Stan Druckenmiller talk about, that suddenly makes the technical price target of $7,000 by 2027 look very conservative. In my opinion, even with the potential competition from the cryptos like Bitcoin, gold could still have the potential to go 5x from here over the next 5 years. But regardless of different price targets, gold is definitely ready for a massive breakout into a major bull run. Now the question is, as a retail investor, how to play the gold market and make the most out of it. I will share with you guys 3 different ways in this video that are most suitable for the retail investors. First, which is also my favorite, is to buy out of the money LEAP call options on GLD. LEAPs stands for Long-Term Equity Anticipation Options. Basically, these are the option contracts with longer than 12-month expiration days, which is an extremely great way to play mid to long-term game with high convictions. For example, here's the option chain on GLD January 2023. Right now, the price of GLD is $177. So any call option contracts with a strike price between 180 to 185 are the ones that you can start accumulating at this moment. Of course, there's just so many things and the details that we can talk about when it comes to options. I want to keep this video short, so please let me know in the comment section below if you are interested in learning more details about how to make money with LEAP options. If I know some of you guys are interested, I will make a separate video in the near future to talk about it. Alright, the second way is to directly buy gold miner stocks. These are some of my favorite gold miner stocks that I believe will benefit tremendously from this coming gold bull run. In fact, stock ticker GLOD was exactly the stock that Warren Buffett has been aggressively buying since 2020. Of course, if you don't know which company to buy or you are not familiar with the gold mining sector, you can always buy gold miner ETFs like GDX. The third way, which is also a much more aggressive way, is to buy LEAPs call options on gold miner ETFs like GDX. It is exactly the same strategy like the first one, but with gold miner ETFs as the underlying assets. You should expect and prepare for a much higher volatility if you pick this one. And of course, the potential return could be the highest. Again, if you want to learn more about how exactly LEAP's option strategy works and more details on how to use them to make the most profits, please let me know in the comment section below. I will see if I should make a video sharing with you guys different option strategies with LEAP options. Alright, hope you guys enjoyed this video. If you are new to this channel, my name is Vic. Thanks so much for watching and supporting the channel. I will talk to you guys soon. Bye for now.